family, younger families have competing demands for their money, the mortgage,
Right.
setting up a house, buying cars, furniture, and that
The
kind
next
of
child.
So it doesn't always work that way. But certain people, their style of saving is to have a little box that they put money in for a specific purpose and then not touch it for other than that purpose. So if that's the case, then that's great. There are various tools, various types of account that are favorable to college savings, so they should put money into that. Other families, perhaps as long as they're saving. I mean, it really doesn't matter to me where they save as long as they are saving. And if they're saving, then at the end of this 17, 18-year period when a child's ready to go to college, that money might be in a Roth account or IRA account, or it may be in a business that they've set up which is generating income. So the main point is that they should save. Let me just give you a few numbers here. So if a family was to save $200 a month for 10 years and earning, let's say, 6%, over the 10 years that would grow to $32,600. That's not a huge amount, but it's very useful in paying for college. The alternative, though, is if they didn't save that money and then had to borrow $32,600 during that college period, and then were to pay off that borrowing over 10 years at an interest rate, typical interest rate on a parent loan is about 8.25%. Instead of saving $200 a month, what do you think the payoff or the debt payment would be on that same amount of money per month?
Might be more like 250 or maybe 300.
Actually, 400.
400, geez.
So
here I am, I'm the accountant.
that's the benefit of saving. 200 a month now,
Yeah,
400 a month later.
yeah, because you have to pick up that interest. So you're paying the interest instead of earning the interest. Ouch.
That's it. Absolutely.
Yeah. All right. Now, practically speaking, when do people actually usually start planning?
Well, I'm in business, and one of the basis of my business is that a lot of people don't start planning until the child starts talking about college, until they see literature in the mail from colleges. We're talking about maybe even junior year or senior year. Hopefully sophomore year gives you a little bit of time. Junior year, the very first semester of junior year is okay. After that, we're really into something called late-stage college planning, late-stage crisis planning.
Ouch. Okay. Let's talk for a moment about when you're actually choosing the college, or college selection, I guess you could call it. Why is that important from a financial point of view? And what role does the family budget play in this decision of choosing the college?
The selection of the college is very important. It's first of all, from a cost point of view. Colleges cost very much different amounts of money. So you can get a state school, which, talking here in California, might be at about $20,000 to $22,000 a year now, when you include the living expenses of a child living away from home. A UC is at something like $28,000 based on that, and private colleges can go over $50,000. So, at the end of it, at the end of all these, you have a degree. Maybe at some colleges you have a degree and a network of people that you can utilize later on in life. But that's a big difference. Tuition can range from about $4,000 a year to over $35,000, $40,000 a year. That's a big difference. So
Yeah.
you need to take that into account. And the first thing I think that families should do, or the first mistake they make if they don't do, is to budget. What is a budget? A budget is, I've got this amount of money available to spend, and I've got this expense. If the expense is bigger than the amount of money I have to spend, I'm going to go into debt. So let's start by seeing how much money you have available. And then we can say, well, that money available is going to finance this type of college. It may be that some kind of colleges just won't work. It may be that other kinds of colleges are very easy, very affordable to a family.
Mm-hmm.
So let's start with a budget.
Okay. So what should a family work with to make a budget?
All right, the typical family, or certainly the people that I make presentations to, they would like to start with the idea of using other people's money. And then the first stop there is financial aid.
Mm-hmm.
So, and that's a good thing, to understand the financial aid system, understand how much that can help you. There's families who haven't researched this often have a very black and white view of financial aid. They either think they're not going to get any and therefore it's not worth applying, or they think it's really going to pay for college and they're home and dry. Right.
Okay.
That's probably not going to be the case, but let's start with financial aid. Once we work through financial aid, the next place parents often look for is scholarships. Well, what about scholarships? Well, scholarships help me. So we can work through that. And then we come within the family to the resources within the family. Actually, a good place to look for savings is the tax system, the IRS. If you're not sending $1 to the IRS in taxes, then that dollar is available to pay for college. Then within the family itself, the student can earn money during the college years, so that more money available. Grandparents or other family members, will they be willing to chip in? And then finally, you get down to the parents themselves.
The last person that they want to count on, right?
Right. Where will money come from the parents? It can come from savings. Hopefully there's some savings. It can come from income. Mm-hmm. The kid's going off to college. He's not at home eating and costing money at home. So there's a bit of money that will be freed up there that can be still sent to the college to help pay those expenses.
Okay.
So, and then if we go through all of those things and there's still a gap, then we're talking about loans. We're talking about student loans and parent loans.
Okay. So what is the result of this budget comparison? So you're looking through, okay, now what sort of dollars are available? So what is going to come out of this?
Well, that's it. You have an expected amount of money that is going to be available for college without taking loans, let's say without taking loans. Mm-hmm. And then you look to match it with the net cost of a college, the out-of-pocket cost of a college. And that's not the same as the cost of attendance of a college. When you look at colleges, one of the first things you look for financially is the cost of attendance. This is something you can get from various reference books or the website of the college. And that's, as it sounds, the cost of attendance. It's the cost of the tuition and fees, the room and board, and some other costs like travel expenses and personal expenses for the student. So that's a starting point, but the college themselves might be willing to change that, to reduce that, to give a discount on their tuition through means of merit aid, a scholarship. So if, let's say, your budget says we have $30,000 a year that we can spend for college, given the fact that we're going to get financial aid and a number of other sources of help. So we have $30,000 a year. So we could apply to a $30,000 a year college, and that would work. We could also apply to a $40,000 a year college if they would chip in $10,000, or a $50,000 a year college if they would chip in with $20,000. It's not going to work if you apply for a $50,000 a year college that won't chip in any money.
Obviously.
That's going to result in $20,000 a year of debt. And the saddest thing is, I think, when the family didn't do this and the child gets an offer of admission at a college which is $50,000 a year, and the family realizes that it can't afford it and the child's not going to be able to go.
And then you have a long face, maybe a little while around the house.
Right.